This conference will now be recorded.
Good morning, everyone. Thank you for joining me this morning for this live trading session. I wanted to point out a couple of things. Obviously, the market is down for a second day, the second day in a row, which is good if you are short and good if you think the market is putting people in a bad position again by going up too much, too fast. So, and I'm in that camp that the market was going up too fast and we need to slow down. I obviously don't want us to go back to lows or want us to, have these 5, 7, 6% days again. But it seems irrational for us to only be at one time on the NASDAQ only 8% away from its all-time highs, and those all-time highs were way too ridiculous at that point. So it's good to see the market kind of calming down a little bit to the upside. And in my opinion, what is reflecting how bad things are out there is oil. Oil is obviously falling completely out of bed. At one point today, it was it was 13 something, so over 30% down, and it might go back to those lows. Really interesting. The kind of point out what went down yesterday with oil being a negative number. Oil has different contracts. Oil is like futures contracts is like options. They have an expiration date, but they do not have time decay. They keep their value, but you have to roll the contract to a new contract. So, for example, this contract has expired. Um, you can't buy it anymore. Most brokerage firms won't let you buy it anymore. But this is the last day you'll see this contract. And if this contract, once it's over, you have to manually switch to the active month. And most people switch to this active month about a week before the contract expires. It's a few stragglers that stay in that, and those people could cause the market to be distorted the way it looked yesterday. And then we had the headlines of oil being down, less than zero for the first time ever. That is technically true, but it wasn't truly trading that way. You couldn't buy oil at that price. The active month was a lot higher at that time, 20 something dollars. Now, obviously, it's in converting or converging to what the cash was yesterday, and so it's going lower. Most of the time, these contracts will as it gets closer to the expiration, as you can see here, this contract is 28 days. Let me try to get this to work. This contract is 28 days to go. This one is 62. The 62 day is trading almost at 23 at 22.93. This one is trading just under 15. As this one gets closer to this date, or this 28 becomes less and less, about to expire, it normally will converge onto this one, get closer, and they're almost exact at that point. This last time it didn't happen. The spread before yesterday afternoon, the spread was about 10 points wide. That is huge. That was the biggest spread I've seen with the expiration just one day on a contract. And then obviously the cash fell apart, but the active month stayed over 20. But today it's going down quite a bit, and maybe we're going to see single digits with oil, which is unfortunate because it's going to hurt a lot of oil and gas companies, and it's already hurt a lot of companies here in Houston and here in Texas. And unfortunately, some people have already been laid off or and might not come back for a while because this oil is pretty bad. But I'm thinking it's still transitory because once we get the economy up and running again, oil demand and oil is going to pick up again, and these prices are super low. So there's still an opportunity right now if you have the capacity to hold, to be able to hold your position for a second. And the best way to be able to do that, in my opinion, is using the ETF right now, because it's basically trading at a option price, a cheap option price. So let's look into that. I'm looking to actually sell some of that. I'm going to break down some couple things. So you see here, I have an oil position on, and unfortunately, I didn't get the chance to show you this live, but I'm going to kind of recap what happened a little bit, and then we're going to do a few things live here. I was helping someone today in oil, driving to work, and I decided to pull over, use my phone hotspot to assist, and then I decided I would adjust this position as well in this account. So initially, this position was here. These were the two spots. The short was a 12, the long was 11. So very small position, but oil is a big contract. This is why you have to trade it small, especially if you have a small account, because every point is $1,000. So that's big, right? So you shouldn't be doing wide spreads in this, because if things fall apart, especially now, there's so much volatility in it that it could hurt. So I was still far out of the money, but I decided that I would roll this position. So I moved the short 12 strike to the 10 and moved the long strike to the 9. So kept it a 1 point wide spread, but just moved it from the 12 to the 10. And if we go and look at the position here, let me clear this for a second, and we go here, it's 23 days to go, and the 12 strike is now at the 22 delta. So I could have waited. I could have held a little longer, but I decided to move it to here, and now this is the 17 delta, just to give a little bit more room. And that here cost, I bought it back for 12 here, and let me show you what that was. So right now, I bought it back for 12. It's trading for a little bit higher than that right now. Well, it's just fluctuating. There's a lot of volatility here, but I bought it back for 12, and that cost 137, 138 to do. And then I sold a call spread. I had something on the call side. I had this position on at the call side, as you can see here, but it was so far away, and it was some glitch going on with Tastyworks this morning that I couldn't close this out. So I just disregarded that, because the margin for the most part was disregarding that, and I sold a 1.5 point wide spread on the call side to finance that move. That was 138 to roll away. When I did that, I received 191 to do that. So I financed that completely and actually got about $60 more. And so I could decide to take this off here for $1 or $10, because it's 1 point. You can take this off, and it's trading at 1 point right here, which is $10. And I can get $7 in buying power, and then just take off. It's going to cost me $13. So this is insignificant, but I'm just going to remove it anyway. And if I get filled at 1, then I get filled, and I'll take it off. But if not, then I do not, and then that's fine as well. Just in case oil spikes back up. I'm one of these conspiracy theory people when it comes to oil, that one of the things that could get oil back up and running, if somehow mysteriously we go to war. If we go to war, then oil is going to spike up quite a bit, in my opinion. And so I'm just going to be a little bit more vigilant on the upside here. So that's why I'm going to put that in to take off at 1. But I'm not going to put it back up. I'm not going to move this to 2 so that I can get filled. I'm going to keep it at 1 and let them fill me at 1. All right, so that is the oil position. I do have a USO hedge on because we talk about hedging, everything we do for the most part, or at least 68%, one standard deviation of what we do. And I have a hedge on in the USO, and that is up quite a bit. So far, the long leg is in the money, and I'm up 84% on it. It's not a big dollar amount. It's only $21, but that's still 84%. All right, so um, I was looking to put a trade on in that, but and let's look at that. So yesterday I gave some trade ideas with this. I'm going to go to the 59 days, and if I'm looking at oil here with 59 days, I'm willing to own this, right? So I could sell the 359 for a mid price of 122. And if it goes down, my cost basis is going to be at the 228. Okay, so that's because I'm selling at the strike. You minus the monies you receive, your cost basis is going to be 228. So in this range over here, or I can sell the 3, and my cost basis is going to be basically 205, and or actually a little less than that if I was the mid pretty much. Or I can literally sell the 2.5 strike, and I can do that for 75 before fees and commissions, and then my cost basis is going to be 175. To me, this is an amazing trade to do, especially for a small account with 59 days to go. So I'm actually going to put this in at 75, and I'm going to send this. And if I get filled, and I got filled pretty quickly because oil is going down some more. So now I own that, and my cost basis is 175. Oil goes down, that's basically almost another 50% down. I just say 175 minus 3.08 divided by 3.08. That is 43% down before I start losing on that. And is it impossible? It's not impossible, but it's not probable in my opinion. But we will see. All right, so let's look at some of this other stuff that we have on. We have a position on in this call side here in ES. I'm just going to open this up for you so you can see what I'm looking at here. And the ES is quite a bit away. That's on the call side. That is a 2 delta. And then on the put side, which we've rolled up a couple times, now it's a 16 delta. So just in the warning area of what we talk about. So if you are new, we talk about the green area being 0 to 15, and the yellow area 16, where we need to be vigilant at 16 to 30, and then 31 and above is the red area. Okay, this is yellow and this is green. All right, so normally we roll out on an initial position if it's an option on the future, and under the 10 delta at 35, it's a rollout. We roll out at 45. If you're trading options on stock, and if you looked at those bonus content on the Dorian Way School in course 1, we roll out at 45, and we'll talk about that more in the future. All right, so this position is okay. I'm not going to do anything to that except perhaps look to take this off, but I'm going to bring it down a little, see if they're fooling us about the price on that, and we'll see if we get filled at a lower price. And then looking at the IWM, this is a position that I am up on because this is a broken wing butterfly hedge, and then this right here is a short call spread that we sold, and this short call spread has made about 80%. So let me delete that, and let's see if we take off this call side here, but we're going to do it a little less to see if they can give us some capital. If you're trading options on stock, Tastyworks has good to cancel, so I'm going to put this in at good to cancel down here, and we're going to send this and see when they fill us on that. All right, so the next thing I wanted to point out is a position we put on in QQQ. We put on an iron condor, and that iron condor right now is down a little bit. But if we look at the stats here with 59 days ago, it's a long time. The put side is at a 20 delta. We probably started this at maybe a 15 delta or something such as that, I'm sure. All right, and then on the call side, it's a 13 delta now. All right, so these two positions are still really good. We're going to let that bake a little longer because it's 59 days to expiration. And this last thing here is just a butterfly hedge in the SPY to cover some of this stuff here on the downside, the put side, obviously. All right, so let me open it up for any questions. Please remember, when we're doing these kind of things, you can interrupt me at any time. But do you have any questions regarding oil, regarding anything, even regarding your account? If you do, please unmute your mic and present that question. If not, we will end this session, and I will check on everyone a little bit later. All right, so any questions this morning? All right, so we don't have any questions. All right, perfect. So thank everyone for joining. I will, this one I'm going to be adding to YouTube. So if you want to look at the replay of this, please go to YouTube. All right, thank you so very much. Talk to you soon. Bye now.